is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Global equities slump, government bond yields climb after a second surprise rate hike this week. We discuss market volatility and the role of technology with the world's largest publicly traded hedge fund. Rishi Sunak pushes for closer economic ties with the U.S. ahead of his first visit to the White House as UK Prime Minister. We look at the diplomatic challenges and future of free trade with the European Union's former Brexit negotiator, Michel Barnier. Plus, Saudi Arabia may have secured a shock merger with professional golf, but the kingdom has missed out on football icon Lionel Messi. Well, he's turning down $400 million a year in favor of David Beckham's club, Inter Miami. So quite a lot going on, and we have a really packed show full of stellar guests. But first thing is first, let's get onto the markets, because there is also a lot going on with the markets. If you look at the surprise Bank of Canada rate increase, leading traders to really reassess the risks for a stubborn inflation. It does mean that, for example, tech shares are bearing a lot of the brunt of the jitters over some of these higher interest rates. And look, to put it very simply, bond yields are rising, and that could continue going forward. Treasury yields ticking higher after an increase across the curve yesterday that at some point added 14 basis points to the 10-year benchmark. To put it simply, the fact that there was two unexpected decisions to deal with inflation, so Bank of Canada, and that followed an earlier increase in the week in Australia, is continuing to reverberate across global markets. So to talk about inflation, the dynamics for some of the specialist strategies, and of course what markets are asking for, I'm delighted now to be joined by Giuliana Bordigoni, Director of Specialist Strategies at Man Group, the world's largest publicly traded hedge fund. So Giuliana, thank you so much for joining us. I mean, the markets are just a little bit odd, right? They look about inflation, they look at a number of things. You're a quant specialist, you're a mathematician by trade. What are clients asking you?
Good morning, and thanks for having me here. So I think you're right. I mean, what we have seen in the last year and a half or so, what we have seen a positive correlation between bond and equities, especially on the downside, which meant that the traditional portfolio, 60-40 portfolios, have suffered losses. So what clients are looking for diversification from this portfolio, and they are looking at alternatives in general. So they are looking at trend following, which is one of the strategies that have worked across the industry in the last few years. You mentioned inflation. Well, if you look at when trend following does well, it tends to do well in period of high inflation, and it tends to give a bit of protection during crisis, which is something that in the current moment is fairly topical.
So, Giuliana, when you look at the inflation, and for me it's unclear whether the markets understand that, if we're dealing with inflation for longer, it means interest rates are going to be higher for longer, and therefore that changes some of their strategies. What do you think is, when you look at your markets and some of the specialist strategies, that investors are not fully understanding right now?
So I think that our main point of view is like to diversify away. So right, when you think about inflation, when you talk about interest rates, is one part of our portfolio, yes. Right? We tend to trade across all asset classes, which means that you will have, if inflation stays high, probably you have like some trends in the commodity space, that you have trends appearing. Mm-hmm. And that is sort of what we have.
Yeah. But is it new trends? So, and this I find quite powerful. Is it trends that were already starting to emerge that have been reinforced, or is it new trends in this new environment that clients are asking for?
Well, I think that, my point of view on trends is that trends is not for one environment specifically. So when you invest in trend, for me, is you invest in trends for the long term. So it's not about when there is a trend, the idea of a trend following system is that it will capture it. Whether it's a new trend, if it's an appearing trend, and so on. So if you look at this year, where we have seen trends, fixed income has been challenging. Because yes, now we are seeing interest rates rising again. We have seen interest rates rising in January and February, but we have seen also like a very strong rally when on the regional U.S. regional bank, let's call it crisis, right? So what I mean is that like fixed income this year, I wouldn't, well, last year it was a strong trend. This year I wouldn't call it the strongest trend we have seen. But we have seen trends in other asset classes. So we've seen trends in some of the FX, both on some emerging market appreciated and in some, and on the other side, on like the dollar appreciating versus some currency like the yen, for example.
So, Juliana, are you expecting this volatility, this kind of volatility that basically leads to, you know, a change in market strategy to continue for a long time? Because markets have, frankly, just, you know, they seem they're all over the place.
I mean, I think that if you ask me what has been the main change in markets, it's been the volatility side. What I mean is that we've seen higher volatility pretty much across the board. And it is motivated by like inflation, as you say, by sort of fundamental variable. So I do think personally that is going to stay for a while. So I do think that this environment of high volatility is here for a while.
There's a buzzword, AI. It touches everything. I mean, there's so much excitement about AI, and it kind of came out of nowhere. I mean, where do we end up on AI? What does it mean for market participants?
So I think that we have been doing AI for many years. So, I mean, I started about 15 years ago, and we would start AI. We started doing AI like soon after. So what I mean is that for us is one of the models, one of the methodologies that we apply to a few markets. So for us, it's not a new thing. Yep. Clearly, in the last year, there has been the massive disruption that's been created by ChatGPT, so more like generative AI. How do I see it? I see it like in terms of the models that are behind that. There is like these language models that clearly they have progressed a lot. And we know that GPT-4 is much better than GPT-3.5, which is telling you like the progress and the development in the models themselves. Now, the main disruption in the last few years is that if in the last 10 years we needed experts to write a machine learning model, now you don't. Now anyone from a computer can just say, I want to write a sentiment indicator, and and you don't need to know any NLP, well before you did. And so definitely I see some use in NLP, so like writing and sentiment indicators in terms of like signals and so on. But I see it also a massive tool for like learning, like sort of, it really is an efficient way of accessing knowledge. It's a nice way of summarizing. And so I think that is like another way of using it. It might be helpful even in idea generation, because it might be easier to find the variables that are driving a certain company that you might think of. So
this is not hype, right? It will change. Maybe we're expecting too much of it in the shorter term, but you think it will change? Does it change the way that quants work, or the way that, you know, for example, hedge funds use quants and quant models?
I think it's going to be more on the quant side, because as I said, quant sort of have been doing it. They do have the expertise. It might make the job of the quant quicker, in the sense that it might be easier to code, it might be easier to access some knowledge. I do think it might change more the other side, what I mean, the discretionary side, because at that point it might be easier to access sort of quant tools and so on. So I see it as a tool.
Juliana, thank you so much for coming on today. Juliana Bordigoni, the Director of Specialist Strategies at Man Group. Now, also coming up, inflation, sustainability, and changing consumer trends. Just some of the challenges facing the industry as the London Fashion Week kicks off tomorrow. We'll be speaking to Caroline Rush, the Chief Executive of the British Fashion Council. Don't miss that interview. And then after that, we also speak to Michel Barnier of the EU. This is Bloomberg. So London Fashion Week kicks off tomorrow as the industry grapples with inflation and changing consumer trends. Now we're joined by Caroline Rush, the Chief Executive Officer of the British Fashion Council. Caroline, thank you so much for joining us. There's a lot to talk about because Good morning. This is a huge industry, of course, for UK PLC, and they're going through a lot of headwinds. It's cost going up. It's, of course, doing trade. What, as you speak to a lot of these industry leaders, what do they tell you they're most concerned about?
So it's challenging times. It's been a turbulent few years. Immediately, it was just the cost of doing business and time, paperwork, post-Brexit. And that continues as businesses grapple with it. A lot of people have had to employ extra people, you know, just Warehousing's had to move to the EU because it was just getting too expensive and too timely to bring goods in and send them out again. So we've seen that jobs have gone, unfortunately, and have moved to the EU. So there's a definite impact already in terms of the industry in the UK, and there's a lot of pain being felt around that. And tax-free shopping, obviously, is front of mind. Rising costs, cost of borrowing, you know, all of the things that put extra pressure on businesses.
I mean, do you lobby the government to try and get tax-free shopping? And if you look at the numbers, and we heard actually the Burberry chairman really go after the Prime Minister and saying, look, it just doesn't make business sense because people are, especially Americans, that spend a lot of money on luxury are just going elsewhere to buy it.
Well, I think everybody's going elsewhere, and I think that's the challenge, is that industry are seeing the real-time numbers, they're seeing the real impact. Of course, is that when we were during the pandemic and it was decided that tax-free shopping should go, it was muddied by the pandemic, but of course is that now tourism's coming back, is that everybody's feeling that impact. And for businesses that have retail in the UK and they have retail in Paris and Madrid and Milan, they can actually see those figures, real-time data. So, is that what we're doing is sharing some of that data with government so that they're understanding the real impact. And it's not just the international tourists that are spending more in Europe. So all EU countries have tax-free shopping. The UK doesn't. But it's the UK consumers. I think one of the businesses said that their shop in Paris was up 200% of UK consumers who are going to Paris to buy their luxury goods and basically getting a free weekend out of it. And what that means is that when you're looking to invest in retail, is that you're going to go where the numbers are. And of course, we want investment to come to the UK. We want the jobs in the UK. And it has a spillover impact in terms of hospitality, in terms of, visitor attractions, museum numbers are down. We really need to think about addressing this, certainly in the next few months.
Yeah, because it's a whole ecosystem.
It really is.
Is the Chinese shopper back?
They're starting to come back. Is that when you look at the numbers, I think we're seeing some of that. But of course, is that a lot of that tourism, again, is going to the EU. From a visa perspective, it is easier for them to travel to the EU. So why are we making it difficult? We want the tourism here. We want the spend in the UK. We want the investment from international brands to be part of our high streets to make sure, not just in London, but throughout all of the tourism destinations we have in the UK, to make sure that that's thriving. So it's something that needs addressing really quickly.
And Caroline, and you've always, of course, lobbied also for more sustainable. You've always lobbied basically, the causes of the luxury sector to the government. In terms of sustainability, are we really making progress, or is it done in such a way that it's become prohibitive?
Well, I think is that from an industry government perspective is that the pressures on cost is actually seeing the need to come together and collaborate. So we're quite hopeful around the opportunity of having programmes that will look at industrial change within the UK and investment in some of the innovation and some of the infrastructure that's needed to actually get to sort of circularity ecosystems in the UK, which is that's the utopia. Yes. It's what we're aiming for. But certainly there's legislation coming from the EU. Most of our businesses trade within the EU, so we need to make sure that we are ready to do business for that. And in fact, I was in Brussels yesterday with my European counterparts, talking about how that kind of legislation isn't just about thinking about compliance for the fast fashion businesses, but we're protecting the creators, because a lot of the designers that are taking part in London Fashion Week, the emerging designers that are coming through are sustainable businesses. They're using upcycle, recycle materials that can be repaired, and we want to make sure that we're protecting those businesses and putting the creators front and centre.
How hard is that, when we were dealing with inflation? Actually, London Fashion Week also starts tomorrow, which is exciting, because after a couple of years of COVID, at least it's back, and in the physical form.
It is. So it's really exciting to have London Fashion Week back. Is that in February we had a full-blown fashion week of shows. In June we're actually piloting a new concept that we'll roll out properly next year, which is about celebrating menswear, the storytelling, the craftsmanship that goes into our brilliant menswear businesses, and making sure that that's not just for industry but for consumers as well, that we're able to tell that story. We have Fashion Week as well in September, which will be fully loaded and really exciting. And actually September Fashion Week, I think, is the second largest shopping moment other than Christmas. So we're really looking forward to that, not only showcasing our incredible designers on a world stage, but equally, hopefully, boosting those retail figures as well.
Caroline, is menswear, I don't know if margins are different actually in women's wear and menswear, but I feel like, Savile Row and some of the savoir-faire here in the UK is so towards menswear, but it gets a little bit less love. Is that fair?
Well, I would say that it gets less probably media headlines because they're not necessarily doing the fashion shows, but actually there's such a brilliant opportunity to tell the stories. As you said, Savile Row is known the world over for its craftsmanship, is that we have people that travel the world to come to the UK, and in fact many of the tailors on Savile Row go to international destinations and are there talking to the consumers. And there isn't a better example really in terms of sustainability. These are clothes that are built to last, to be adjusted and altered for many years to come, and it is something to be celebrated. But equally, we have incredible young designers, emerging designer businesses that are building a business on the world stage, that have fantastic sustainability credentials. And in terms of the UK, is that we're known for our creativity. In fact, creativity, I think, in fashion is a hallmark for European fashion. But in the UK, we're known for pushing those boundaries, and we're going to see some of that over the next few days, which is really exciting. And more importantly, we're going to be talking about the future of menswear and actually how the UK as a community can really come together and to celebrate that.
Yeah, and I was looking at numbers. Again, it's big business. Caroline, thank you so much for joining us.
No problem.
Today.
Thank you.
Caroline Rush there, the Chief Executive Officer of the British Fashion Council. Now, coming up, we talk football. Lionel Messi is turning down a $400 million Saudi offer to go to Miami. We have the details next. This is Bloomberg. Welcome back to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News with Sarah Halls. Hi, Sarah.
Hi, Francine. Bloomberg has learned that Donald Trump's legal team has been notified the former president is a target in a federal investigation into the handling of classified documents. Prosecutors have been building a case that includes testimony from former aides, including former Chief of Staff Mark Meadows. Trump says he hasn't been told he's been indicted and has done nothing wrong. The mayor of New York has told residents to stay indoors or wear N95 masks if they go outside, as smoke blankets the region. This as wildfires continue to ravage large tracts of forest in Canada, sending smoke more than 1,000 miles southward. Prime Minister Justin Trudeau says it's the worst wildfire season in Canada's recorded history. Japan's economy grew more than expected in the first quarter as businesses ramped up spending. Revised data show GDP rose 2.7% annually, up from an initial reading of 1.6%. The data means Japan avoided a technical recession at the end of last year. The Bank of Canada has surprised with a 25 basis point rate hike, restarting its tightening campaign. Policymakers raised the lending rate to 4.75%, the highest in 22 years. The move ended the pause through hikes declared in January, with the BOC citing an overheating economy. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Francine.
Sarah, thank you so much. Sarah Halls here in London. Now, ticket prices for Inter Miami's away games are soaring after Lionel Messi announced plans to join the U.S. Major League Football team. Now, Messi's move is a significant blow to Saudi Arabia's global sports ambitions. For more, let's get straight to our Joe Easton. So, Joe, first of all, wow, Messi turned down a contract that would have basically given him $400 million a year. So how big a deal is this?
Yeah, I think it's a massive deal. I think that the negotiations with Saudi Arabia made it more high profile. Everyone thought he would either go back to Barcelona or go to Saudi Arabia. But obviously going to the US has come as a big surprise. But I think some of the contract details are what's taken him there potentially. There's talk of Apple potentially contributing towards some of his payment, and also Adidas. There might be hidden details in the contract that we haven't quite heard yet. And that could be part of it, I think.
I mean, I know we're not like into the psyche of football players, but what would make him go there and not Saudi?
Well, it's already been done, I guess, with Ronaldo going over there. It's not a new thing now to go over to Saudi. There's talk of Benzema going there, even Kante from Chelsea. So kind of lots of players going over there, whereas a high-profile name going to the US. David Beckham was obviously a massive one, but that was more than 15 years ago now. That changed the league, and now it's time to kind of reinvigorate that, I think. And
then, Joe, we have a wonderful, wonderful piece actually looking at a breakdown of, sovereign wealth money, some of the private equity money in football overall. The former Qatari PM also sweetening his deal to take over United.
Yeah, so they're potentially coming back with a fifth bid, trying to outbid Ineos, which is owned by Jim Ratcliffe, the big UK billionaire that supports Man United. The Qataris want to get it done by the open of the transfer window, which opens on Wednesday next week. So they want to be in control of the finances before Man United start spending money, to make sure they know where the money is going, make sure they're within the fair play rules in terms of finance as well. So that's exciting. That could happen potentially, according to our reporters on that story there.
All right, Joe, thank you so much. So much going on, actually, when it comes to football. Joe Easton there with the very latest on potential bids. Now, bond yields are rising. Stocks are actually falling. Tech shares bearing the brunt of jitters over higher interest rates. Really, it's the unexpected decision by the Bank of Canada to restart its interest rate hiking campaign, which followed an increase earlier in the week in Australia that continues to reverberate across global markets as traders are reassessing the risks of stubborn inflation. Coming up, as Rishi Sunak visits the US, we'll discuss Britain's global standing after its split from the EU. Our interview with Michel Barnier, the former chief Brexit negotiator for the European Union, is next, and this is Bloomberg. Well, good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, they call it the special relationship, and that's being put to the test this week as British Prime Minister Rishi Sunak visits America. Now, the UK is seeking closer economic ties with the United States. Sunak will meet President Biden later today, but don't expect progress on a free trade agreement. Now, the White House has maintained a freeze on talks, and the UK Prime Minister says a trade deal is not a priority right now. He says the focus is on making sure that their economic partnership reflects the challenges and opportunities of the time, and that includes support for Ukraine, responding to China's growing influence, green subsidies, and cooperation on regulating AI. The visit comes as Britain seeks to boost its global standing after Brexit. Now, let's unpack all of this with Michel Barnier, the EU's former chief Brexit negotiator, who's also now the author of a book, My Secret Brexit Diary, which we'll get to in a second. And we're also joined by Leslie Vinjamuri, director of the US and America's program at Chatham House. So thank you both for joining us. This is a big day, certainly for the UK and for Rishi Sunak, as he will spend a bit of time with President Biden. How does the US now view the UK post-Brexit?
Oh, good morning. And frankly speaking, I wish the best for this visit from Rishi Sunak to President Biden and meeting many people, key businessmen in the States. As usual, there is a special relation between the UK and US, very, very long in history and very strong. And once again, I wish the best. As far as trade is concerned, at the end of the road or at the beginning of the road, there is an economic reality. We are now in two separate markets, UK and EU. And the reality is that the EU market, single market, count 450 million consumers and citizens, 22 million business. That is the reality. And if you are on the side of the US or China or India, they know this reality.
Yeah, and Leslie, I mean, what the Prime Minister really wants is this agreement, right, which we've been talking, which actually we were promised by Boris Johnson. Will they ever get it? And if so, is there any willingness from the US to give something to the UK in terms of trade?
I think right now it's very clear that that sort of idea of a US-UK free trade deal has been parked for quite some time. But so I think what Rishi Sunak is trying to do, and quite frankly, probably President Biden is trying to do, is to find wins where there can be economic cooperation, whether it's that US-UK critical minerals deal, which would help the British automobile industry in particular to be competitive on electric vehicles, selling them into the US market. But I think the real economic win that the UK is looking for is this focus on artificial intelligence. So if Prime Minister Sunak can make an announcement about an autumn summit on artificial intelligence, really forge a partnership with the US and be seen to be leading when it comes to setting standards, asking some of the big questions about regulation, but keeping that space open for innovation. I think that's a really sweet spot for the UK.
But Leslie, is there something that the US actually needs the UK on? Does it need the UK on AI, or would it be throwing them a bone in return for something else?
I think we have to put it in the perspective that right now economic issues are seen to be security issues. And when you think about security, the UK is a leading partner across the board. So it's quite natural for the UK to be important to the US when it comes to economic security. And that means artificial intelligence, that means technology, clearly affected by Brexit. There's no doubt about that, but still with tremendous scope, again, for innovation, the firms that are based here in the UK. And so I think when you sort of put it in that broader light, which everything right now has got to be put in, whether it's with respect to competition with China, support for Ukraine, transatlantic security, that economic question is really, one pillar. It's very much integrated into that broader set of issues.
And Mr. Barnier, you negotiated very harshly with the UK. At the time, you'd warned, of course, the government that there would be consequences economically. Do you think Brexit has gone better or worse than you expected?
The Brexit is a lose-lose game. There is no winner. So it's a divorce. As many people know, the divorce is always painful and costly. So there is a lose-lose game, and we try to face the consequences. On our side, the Brexit is over. The Brexit is on the books. And we spend our energy, our intelligence on the future of Europe, much more than the Brexit. But I can understand that there is now for the UK to face the concrete and mechanical consequences of the Brexit. And as I said at the very beginning of the negotiation, 5 years ago, there is multiple consequences on every and each subject of the daily life.
But there's at the moment a negotiation, right, between the UK and the EU on car factory rules. The European Union has so far downplayed the chances of a deal with the UK on this. Do you think they will be a bit more friendly, as this government and the current Commission seem to be getting along better?
The point is not to be more friendly or less friendly. We face clearly and mechanically the consequences of the Brexit. And as far as the car industry is concerned, as far as financial services are concerned, Brexit means Brexit. You can be out or in the single market at the same time. You cannot dance in two weddings at the same time.
And I understand, but you can put the rules in a way that's more advantageous for both parties and not. That's fair, right? You can come to agreements.
As far it is for both parties.
Right.
But the task and the duty of the European Commission, the European Parliament, the Member State is to defend the EU interests. And as I said, we can face a situation where there is a kind of cherry picking in the single market. The single market is our main asset. The main reason why China or US respect us is the single market, which is much more than a free trade zone. It is clearly an ecosystem with common norms, common standards, same regulations, same supervision, and the same jurisdiction. So that is a single market. So we cannot accept any kind of unraveling of the single market, never.
Leslie, it is also pretty incredible, actually, to know that this is real quality time for the first time between a Prime Minister of the UK and a President of the US. Is Rishi Sunak giving the US what they need on Ukraine and also on trying to deal with China?
I think on Ukraine, certainly. I think on this broader question of Europe, the US is looking to see whether the UK is sorting out its relationship with Europe, whether it can provide this, convening power, some alternative space. On China, I think the UK is very much hewing to the US line, setting out, an independent policy. But when you read the details, whether it's in the integrated review refresh, the foreign policy strategy document, it's very much aligned with the way that the US is approaching China on technology, on the tilt to the Indo-Pacific, which has been achieved, but it's still very significant. So I think there is a real alignment there. But again, for the UK to sort of provide the U.S. what it needs, I think demonstrating that it can forge a positive, productive relationship post-Brexit with Europe, that's the challenge for the current government. That's certainly the challenge for whatever government emerges after the next election.
But if President Biden has to call someone in Europe, who does he call first? Emmanuel Macron of France really tried to position himself as the person to call. Has that worked?
Yeah, I mean, obviously the U.S. has set up this Technology and Trade Council with Europe. That's one forum. But I think there are multiple phone lines coming out of the White House. And I think that relationship with the UK on security is very robust. Security, defense, intelligence, trade and technology, the security aspects of that. Clearly, Europe is extremely important. But I don't think it's either or.
How much has the EU lost because of Brexit?
We lost a key member state. And this member state is no longer a member state. It's now alone, and I think in the global world where we are and what we face, it's better not to be alone, to be together. But coming back to the EU-UK relations, I spent 4 and 5 years on this negotiation with 3 goals in my head. Number 1, protecting the single market. It's for now and for the future. No cherry picking. Number 2, the peace in Ireland. Number 3, building the best framework as possible for the future relation, because we have so many challenges to face together, UK and EU together. You speak about artificial intelligence, we can speak about terrorism, we can speak about poverty in Africa, we can speak about global climate change. There is so many challenges. We need to be together. It's the reason why I think that we can improve our relations, in particular for defense and security. Let me recall that at the beginning of the negotiation, I have proposed to Mr. Johnson to open a chapter on security, defense, and cooperation with Africa. And he refused to open this chapter. Now it's time with Mr. Sunak to begin this negotiation.
Mr. Barnier, do you think there's a possibility that the UK would ever re-enter the EU, or is that never going to happen?
No, the door is open anytime. Anytime. The door is open. The only point I want to mention, it has, I don't know when, for the UK people, for the UK citizens to decide in total sovereignty. The point is to know at that time what will be the size of the divergence on the regulations for social regulations, environmental regulations, fiscal regulation. Because when you join the EU, or when you join the single market, you can be inside the single market, outside of the EU, as Norway. When you join the EU or the single market, the customs union, you have to respect the norms, the standard, the conditions of the EU. So the point is to know what will be at that time. I don't know when, the size of the divergence.
All right, Michel Barnier, thank you so much. Labour, of course, talking about building a closer relationship, so we'll discuss that shortly. Also, thank you to Leslie Vinjamuri there from Chatham House. And now we'll have plenty more, of course, on this special relationship, and we'll have plenty more on Brexit with Michel Barnier. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, still with us, Michel Barnier, the EU's former chief Brexit negotiator. Now, Mr. Barnier is also author of My Secret Brexit Diary, a behind-the-scenes look at the talks with the UK. It's a simple read because actually it reads a lot like a Dear Diary. So you have dates, and there's one, Mr. Barnier, that really, stuck with. It's funny because every day you call, for example, Wednesday, the 6th of February, 2019, a place in hell. And it's a quite personal account of your Brexit negotiations. Are you a little bit sad about how it ended? And Labour has been talking about a closer relationship between the UK and the EU. Do you think that will happen, and what would it look like?
First of all, I wrote this book every day or every night to tell the truth of this negotiation, because I thought from the day one that it will be an historical negotiation. I'm sad about the Brexit. I didn't understand why a great country took such a decision, in my view, against its own national economic interest. But we have respected this vote, and we have delivered the Brexit in the best way as possible. If it's possible to deliver a divorce in the best way. So I try to do that in respecting every day the UK, because I have lots of respect and admiration for this country, respecting my counterpart, but also defending every day, protecting the integrity of the single market. So whatever the future of the next or a future government in the UK will be, we are open. The door is open for any negotiation, but the condition will be, in any case, that the single market will be respected.
But where do you see the opportunities of working closer together on opportunities? Are there parts of the economy or defense that you think would fit, together nicely?
We can improve our relations. For instance, a very specific relation. I spoke about veterinary exchanges to facilitate the trades, but all the rules have to be respected. The paradox of this negotiation, to be frank, is that for the first time in our trade history, 60 years, we have signed perhaps 50 or 55 trade agreements with Canada recently, with Japan, and we have negotiated several new ones. The fact is that for the very first time, we have negotiated a trade agreement with a third country, UK, to rebuild barriers and not to delete barriers. We have rebuilt all the barriers except the financial barriers, the tariffs. But we have rebuilt all the barriers between UK and EU because of the Brexit. So this is the reality or the paradox of this negotiation. I think we can improve to facilitate the relations. We can improve our relation by a new chapter on security, defense, fight against terrorism. We can improve our relation for the cooperation with Africa, to tackle the new challenges about intelligence, artificial intelligence and the new technologies. I think we have a lot of room to improve our relations.
Mr. Barnier, you also talk extensively about personalities, personalities that we've all followed very closely. Do you think the negotiation would have been different with a pragmatist like Prime Minister Rishi Sunak?
I think Rishi Sunak shows a goodwill. The reason why we succeed to finally, 3 years after, succeed to implement the protocol on Ireland with Rishi Sunak, and we lost 2 years with Mr. Johnson. So I think he's a goodwill. But whatever the government in the UK will be, we are ready to improve our relations, and we need to improve our relations, taking into account the Brexit, which is done, but improving our relation in particular for defense and security.
But do you think that had you negotiated with Rishi Sunak, the outcome of Brexit would have been different? The deal would have been different?
Rishi Sunak was a member of the government of Mr. Johnson. So I think the Prime Minister gave the line on the name of the government and the name of his majority. This is the same majority. I don't want to speculate about what would have been this negotiation, but it had been painful, but we have always been respectful for the UK, and I asked just to the UK to respect its own signature, which is not the case for Mr. Johnson about the Irish protocol.
In the corridors of power of Brussels and France and Germany, do people still talk about Brexit?
No. The Brexit is done. The Brexit is on the books. And we are, as Mrs. Merkel said once, the future of Europe is much more important than Brexit, and we have so many challenges to face, in particular the war in Ukraine, the stability of the continent, the new policy for industry in Europe, and to the climate change. So we have so many challenges to face. And what I wish is that to be more successful, we need to build a strong cooperation with the UK to face together such many of these challenges.
Do you think there's a danger that more countries in Europe will follow down the UK path and leave the Union?
No, I don't think so. The consequence of this negotiation, very long and complex negotiation, is that now we no longer listen leaders like Mrs. Le Pen in France or Mrs. Salvini in Italy speaking about leaving the EU, leaving the single currency. But we have to be careful, because the Brexit was improbable, even for the leader of the Brexit campaign, and it happened. And we have to be careful about some situation which seems to be improbable, and it could happen, so we have to draw the lesson. The third chapter of my book is called A Warning. We have to answer to understand the social anger in many regions. It's too late for the UK, but it's not too late for the other member of the country, the EU. We have to listen, to understand, to answer to this social anger in many regions.
Michel Barnier, thank you so much for joining us today. That was the EU's former chief Brexit negotiator and now author of the book, My Secret Brexit Diary. Diary not so secret anymore. Now you can hear more from Michel Barnier in an extended interview on our podcast, Bloomberg UK Politics, also available to download from all of our usual platforms. Coming up, making Britain's pitch for AI, Rishi Sunak seeks Joe Biden's backing as he hopes to boost the UK's influence over regulating the technology. We'll explore that next, and this is Bloomberg.
We've seen the number of people with crypto assets double in the past year to 5 million. And we think it's important to ensure that the way in which crypto firms advertise to those consumers is clear, fair, and not misleading. So these are new, tougher advertising standards, and they're seeking to ensure that we treat crypto assets like high-risk investments, and that the firms are not able to just put out misleading adverts.
That was Sheldon Mills, Executive Director of the UK's Financial Conduct Authority, speaking to us earlier about tougher rules around crypto assets. Now, let's also look at markets, and a lot of the focus, of course, is on inflation. The fact that we had two central banks that surprised a lot of economists, and hiked rates means there's a global repricing on the impact longer term of inflation, what that means for the Fed and the ECB. Now, staying with the UK and the Prime Minister Rishi Sunak calling for Britain to be included in the future of AI regulation. Well, Sunak is making the push ahead of talks with President Biden in Washington, a meeting which he hopes will boost UK influence over regulating the technology. Joining us now is Brendan Scott, Bloomberg's UK Economics and Government Managing Editor. So thank you so much, Brendan, for joining us. First of all, Sunak talking so much about AI, is he trying to get this as a win for the UK?
Yeah, I think he's looking for some sort of common ground with President Biden. The UK has had a hard time finding things that it can relate to with the U.S. ever since Brexit. This is a new issue. It's one that he's been talking about for quite a long time. The debate over it has changed since he's first brought it up, but it's I think he sees this as a place where he can try to get something that works with Biden, get something going, and maybe it leads to other things down the road, like he would hope some sort of trade discussion, if not a trade deal. So,
what does this say about the state of the relationship? I don't know if it's, if this is the only thing he can get from the U.S., so as you say, trying to get in through AI and then hoping for more, or whether, well, at least, this is probably also the biggest challenger of our lifetime, so whether this is actually a win-win.
Yeah, I mean, I think as he sees it as a forward-looking issue. It's also the UK and the U.S. security relationship is ironclad. It's one of the closest in the world. It's certainly among the top 2 or 3 relationships that the U.S. has on a security level. The Prime Minister has set out on this trip trying to make it more of an economic discussion as well. AI is a security issue. It's also an economic issue. This is a way to bridge that. Yeah.
Brendan, thank you so much. Brendan Scott there, Bloomberg's UK Economics and Government Managing Editor. Now, also, listen to our podcast. For banks, AI is like having an army of interns. We spoke to one of our columnists, Parmi Olsen, and a chief executive that works specifically in AI. So we really look at the podcast In the City that I co-host with Dave Merritt, and we look at the crosshairs between AI, banking, and the UK. Bloomberg Surveillance Early Edition continues in the next hour.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Reality check. Global stocks and bonds digest 2 surprise rate hikes this week, reminding investors that the inflation fight isn't over. Wall Street may soon face fresh compliance costs in the United States after a reprieve from Europe's tough MiFID II rules expires next month. And a warning from BlackRock. Vice Chairman Philip Hildebrand says investors must reassess their allocations to China amid rising geopolitical tensions with the US and a slowing economy. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, I feel like saying, oh, Canada. You're dealing with the air quality issues, of course, from the wildfires in North America. But also on the markets, we're dealing with a surprise rate hike from the Bank of Canada coming close on the heels of the RBA's surprise.
Yeah, who knew Canada would have such a big impact in just a 24-hour span in terms of both Wall Street and Main Street, for that matter? Something, of course, we're going to digest throughout the rest of the show. But something really important to keep in mind is the read-through you are seeing from the Bank of Canada into what exactly the Fed pricing is. But look, it's not just the Bank of Canada. The RBA played a little bit of a role here as well. These surprise hikes to the upside really suggesting that, wait, maybe we got to hold on for a second and say, look, maybe inflation is not over. And if that isn't going to kind of increase those Fed hike bets, that's what you're seeing priced into the bond market and really led to the surprise on both sides of the border in North America yesterday. You're seeing that show up in the two-year yield a little bit, 455 here, because remember, overnight, Fed swaps are now pricing in a little bit more hawkishness from the Fed. Whether that translates into kind of a ripple effect for the equity market still remains unknown, because for now, you're kind of seeing the equity market remain flat from the S&P 500 and the NASDAQ futures perspective. But I threw on here and said Russell 2000 futures, because Anna is still a big part of the conversation. It's not just inflation, it's not just growth, it's breadth in the stock market. And you are starting to see a little bit of that as those small caps get in on the rally, as shown by Russell 2000 futures, higher by 0.3% already in the pre-market. So those are some early signs that perhaps we can enter a bull market when it comes to equities. But again, the bond market could change the game when we start to price in those hawkish bets. I think the FX gauge is really crucial here because the dollar actually weakening. If you are expecting more hawkishness from the Federal Reserve, the dollar in theory should strengthen, yet that's not exactly what's happening. Weakness in the greenback to the tune of about 0.3%. A lot of international factors playing to that. We're going to get to that in a second. NYMEX crude, though, trading with a 72 handle, down about 0.5%. Again, reflecting a little bit of those growth concerns. But Anna, I mentioned the Asia story because it is absolutely hitting the dollar. Overnight, you saw Asia weak by about 0.3% overall in the entire region. So seeing that show up in the MSCI Asia Pacific Index. But again, I want to come back to the currency story because you also got some GDP data out of Japan, which we know has been dealing with growth concerns. They're actually posting better than expected GDP, saying the economy is actually recovering. Resilience is a factor. So you are seeing strength there in the Japanese yen, 139.74 on that crosspair. Outperformance in China, though, as we talk about that bid into tech, into AI, the CSI 300 really outperformed and was the outperformer throughout the entire region, higher by about 0.8%. But it's coming at a time when China is exploring stimulus, and this is a really big deal. A big chunk of Chinese lenders talking about cutting their reserve ratios, and that really potentially propping up the offshore yuan as well. So you are seeing that as well, 714 on that currency pair, Anna.
Yeah, and will we see further action from the PBOC, Bloomberg Economics, certainly talking about the possibility of that by mid-June. Let's get to the European equity market picture. And whilst I show you this pretty mixed picture on European equities, I'll just go through some of the breaking news that we had on the euro area economy, contracting by 0.1% in the first quarter on the quarter. So this is this Q-on-Q number, and I think that's 2 quarters of negative. So that would be a technical recession. So we'll get more details on that shortly. This is the picture across European equity markets. We've got the CAC going higher, the DAX going higher, shrugging off earlier weakness actually on European stocks. The IBEX and the FTSE MIB, just like yesterday, we're seeing outperformance coming through from some of these southern European markets. The FTSE much of a laggard this morning. So that's the picture in terms of the geographies. In terms of sectors, it's the higher yield story that still is having an impact. Yesterday we saw the Nasdaq underperform on Wall Street, and that is flowing through into the European session. Tech stocks, one of the weaker performing sectors today, and that sector is down by 1.1%. We saw yields in Europe go higher on that Bank of Canada surprise yesterday, and so maybe that move is done for the moment, and so yields pulling back just a little bit. I put in the German 2-year yield. Others are available. Broadly speaking, we're asking across the Eurozone at least, these yields coming off after those gains of yesterday. This is SBB. That's the real estate business that we like to talk about over in Sweden because it's been such an epicenter of concerns around real estate in the European market. That stock down by 9% or just shy of today. Yesterday, it rallied by more than 7% on comments from the new CEO suggesting he wouldn't sell assets at fire sale prices. Today, the stock goes down. S&P downgrading the outlook, and it goes further into junk. Wizz Air, this, as the name suggests, an aviation company based in Europe, listed in London, up by 1.4%. It was up by more than 4% earlier on, Kriti, as yet another aviation company tells us about the strength of the sort of booking pipeline ahead and prepares itself for a busy summer.
Yeah, resilience seems to be the theme across Main Street around the world, Anna. But on Wall Street, a little bit of a different story, headed for a regulatory fight over how clients pay for investment research when a reprieve from Europe's MiFID II rules expires next month. Joining us now is Bloomberg's Leonard Kenscherper. Tell us a little bit about the background to the story. We know that Europe and the U.S. have really disagreed on this front in the past. What are the developments here?
Yes, exactly. So these MiFID II rules say that brokers have to charge separately for trading and research. And so far, I think for the past 5 years, the SEC has shielded US brokers from that requirement because it would basically mean more costs for these firms. And now that reprieve, that shield is going to expire next month, and we're already seeing a bit of pushback from the industry, and it will be very interesting to see how that plays out, because Gary Gensler said don't expect a further extension.
Yeah, Gensler certainly suggesting, you know, we've told you this, we told you it's coming, get ready. Now, on another subject of interest in the financial services sector, Standard Chartered trimming more than 100 roles as part of a cost-cutting plan. Which are the roles that are affected here, and what are the particular catalysts that we're hearing?
Exactly. So in Asia, our colleagues report it's going to be HR roles, and in London it's going to be a few managing directors in financial markets. The company said this is part of their normal review of business, of course, but it also comes against the backdrop of a drop in trading revenue in the first quarter, and also against the backdrop of these gloomy forecasts that we've seen from US bank executives last week, for example.
Yeah, certainly been a theme, job losses in the financial services sector. Leo, thank you very much. Bloomberg's Leo Kenscherper with the latest on those themes in finance. Now, around the world, investors are struggling to process how to deploy capital as recession risks and geopolitical tensions shake global markets. Earlier on Bloomberg, BlackRock's Vice Chairman Philip Hildebrand said investors must reassess their allocations to China.
Certainly the fragmentation of global geopolitics, in a sense, and at the core of this, of course, is the tension between the US and China, means that you have a very different set of assumptions when it comes to allocating. So what might have been, you know, an obvious kind of play to say we need to increase allocation to China is now has a different calculus driving it, given the clearly the increased political risk premium.
Joining us now with analysis, Bloomberg Markets reporter Justina Lee. How widespread is that view then, rethinking allocation to China, either because, Justina, of the geopolitics and those longer-term concerns, or around the lack of momentum behind the Chinese rebound from reopening?
Yeah, I think those concerns are pretty widespread right now. I mean, as you said, one part of the story is the cyclical part. We all know that Chinese economic recovery has been sputtering, you know, recently. And on the other hand, I think more worryingly is the long-term structural story. And one part of that is, you know, the worsening relations with the U.S. And the other part of that is, you know, China's aging demographics and the drag that could be, you know, on growth going forward. And we can see this all over Chinese markets right now. I mean, you know, in terms of Chinese stocks and the Chinese currency, I mean, those have really suffered in recent months.
Justina, so that's the China story. When you talk about kind of the structural piece there, I want to bring to you the Japanese story as well, because it feels like right now when we're pricing in bets for the Federal Reserve, the market is kind of taking its cue from the Bank of Canada, the Australian Reserve Bank as well. Where does Japan's kind of better than expected growth fall into kind of the global growth story?
Yeah, Japan got some pretty good GDP numbers recently, and that was driven by stronger corporate investment. Even though at the same time, you know, there were some bad, you know, signals kind of hiding in that data. For instance, you know, inventories are going up, and that tends to be a sign that demand is not keeping up with production. I think for now, people kind of expect the BOJ to kind of not rock the boat. There are also political questions coming in here because a lot of people have been speculating that maybe we're going to get a snap election while, you know, the numbers look good in Japan. And so I think, you know, overall still good news, you know, like what we're seeing across the developed world. But I think the question is, you know, where do we go kind of going forward, especially with perhaps, you know, inflation starting to weigh on consumption as well.
Justina, thank you very much. Bloomberg's Justina Lee with those market themes from China to Japan. Let's get back to some Western politics. UK Prime Minister Rishi Sunak wooed US business leaders and politicians as he engaged in baseball diplomacy, we're told, the day before he meets President Joe Biden at the White House. Joining us now, Bloomberg UK Economics and Government Managing Editor Brendan Scott with me on set. Rishi Sunak there in those images doing a good impression of a baseball fan for somebody who actually prefers cricket. What do we make of this so-called baseball diplomacy? It makes me think of US-Cuban relations or somebody showing up at your house with a baseball bat, neither of which are intended connections here. So what do we make of this this effort?
I think what you're seeing there is someone who's trying to show that he's familiar with America. He's a Stanford grad. He's someone who's comfortable in an American setting. He also wants not just the American people, but the decision makers in Washington to see that he's to get to know him a bit better. He's only been prime minister since October. He hasn't had much chance to interact with the US's decision makers on a one-to-one level, and so this is a chance for him to really do that and show that to the world as well.
Talk to us a little bit about the technology frontier. It feels like perhaps the UK in some ways feels left out of that global conversation. Where does Sunak stand on that relative to the US?
Yeah, of course, the UK, London are big tech centers themselves. There's a lot of investment here. There's a lot of people involved in the industry in the UK. Rishi Sunak's trying to leverage that, trying to get himself in this conversation, which right now is being dominated by the bigger blocs, the US, Europe, and of course China. So this is a chance bringing up AI in this context. He sees this as a source of common ground potentially between him and Biden, and potentially a way to steer the conversation, which has been very security focused since the start of the Ukraine war, towards something a bit more economic.
Yes, and so he wants to base a sort of AI regulatory hub in the UK, doesn't he? So we'll see where that conversation goes. Brendan, thank you very much. Thanks for joining us. Bloomberg's Brendan Scott with the latest on the UK politics and that visit to Washington. Coming up, investors reassessing rate hike bets as the Bank of Canada joins the RBA with a surprise hike less than a week away from the Fed's decision. More on that next. BlackRock's Jean Boivin seeing rates higher for longer, with any cut unlikely this year. That conversation is still ahead. Plus, the Super Return Conference is in full swing in Berlin. We will bring you our live interview with Joe Taylor, CEO of the Ontario Teachers Pension Plan. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, it's been an interesting 48 hours because the narrative has completely changed when it comes to central banking around the world. You can blame the Reserve Bank of Australia and the Bank of Canada for that story. It has a very real read-through into the markets, which brings me to a chart. For our radio audience, stick with me here. We are looking at global bond yields, essentially on the front end of the curve, kind of normalized here, but basically what you need to know. Yields, Canada, US, Australia, Germany, New Zealand, basically a lot of these major economies, the yields are going up, up, up. And a lot of this has to do simply with repricing what these central banks are going to do, that we are not near the end of this global monetary tightening regime. Instead, we may have much, much farther to go. And this is extremely important in the context of the Federal Reserve because, of course, we do think that, well, the Fed kind of does its own thing, given that it has the backing of the dollar being the reserve currency for the world. But to what extent do they need to start kind of ripping a page out of playbooks from other central banks around the world? And that's where you're starting to see a little bit of the pricing change. On this topic, I want to bring in a true expert. Bloomberg's Phil Serafino, a fellow American, I might as well add, joins us now to break it all down. Phil, you're an American. You know all about American exceptionalism, the idea that perhaps the Federal Reserve will be different at the end of the day. Will it? Talk to us about pricing here.
Yeah, I mean, the message you're getting from Canada, from Australia is, hey, inflation is still a problem. We need to bring it under control. I was looking at the headline inflation rates around the world. The U.S. 4.9%, the euro area 6.1%. That's way above what the central banks want to see. Everyone says inflation should be around 2%. So that tells you that there's probably more rate hikes coming. The case can be made, look, there's been a lot of increases already, and that's working its way through the system, and inflation is coming down, and it will keep coming down. But, central banks are not going to sit back and take a chance that they get behind the curve. And that's the message you've seen this week. Rates are going up.
And if you're a government and you need to raise money, Phil, and you are also increasingly making the assumption that rates continue to rise, you might decide to issue now rather than wait. We're seeing quite a lot of issue, and it's not least here in Europe.
Yeah, this week alone, sovereign issuers in the U.S. sold $27 billion of debt, busiest week since 2020. So they are clearly taking advantage of this moment now before they see another round of rate increases coming. This week in Asia, there's been a big bout of corporate issuance as well. So the debt capital markets are really, issuers are rushing to borrow that money now before the interest rates go up.
Phil, are they going to be met with appetite, though? Isn't the story of liquidity and digesting this issuance around the world still a big issue?
Yeah, I mean, that can be a problem. There's been a lot of concern about that. I will say, though, it seems like there has been a lot of appetite for especially high-grade bonds. You have buyers like insurance companies that have been starved for years when rates were low, and they still have an appetite for debt. The question is, when do we hit that tipping point when it's just too much? So far, the market has been very receptive to these issues. We'll see how that goes if there's a little bit of stress in the system as rates go higher.
I know that we've got some comments from Ray Dalio on that subject. We'll play those later in the programme. Phil, thank you very much. Phil Serafino joining us there from Paris. And for more market analysis, check out the Markets Live blog. You can find that by typing into the Bloomberg terminal MLIV Go. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Some 230 square miles of Ukraine's southern Kherson region is underwater 2 days after the destruction of the Kakhovka Dam. The regional governor says almost a third of the flood zone, where thousands are being evacuated, is held by Ukrainian forces, while the rest is in Russian-occupied territory. Kyiv is assessing the humanitarian, economic, and ecological damage of the disaster that Western leaders denounced as a war crime. Bloomberg has learned a mood of deepening gloom is gripping Russia's elite about prospects for President Vladimir Putin's war in Ukraine. Many within the political and business elite are tired of the war and want it to stop, though they doubt Putin will halt the fighting, according to 7 people familiar with the situation who asked not to be identified. The mayor of New York has told residents to stay indoors or wear N95 masks as they go outside, as the most polluted air in decades blankets the region. This is as wildfires continue to ravage large tracts of forest in Canada, sending smoke more than 1,000 miles southwards. Prime Minister Justin Trudeau says it's the worst wildfire season in Canada's recorded history. House Speaker Kevin McCarthy called off votes for the remainder of the week and sent lawmakers home. A revolt by Republican hardliners halted business in the chamber for a second day. The blockade by a band of 11 ultra-conservatives heightened tensions among Republicans following the Speaker's backing of a compromise with the White House to avert a U.S. debt default. The Speaker says he was blindsided by the revolt. Soccer superstar Lionel Messi is reportedly planning to join U.S. Major League club Inter Miami. The Argentine legend revealed the move to Spanish newspaper Mundo Deportivo. It would mean he's foregoing a contract in Saudi Arabia worth a reported $400 million a year. The newspaper says Messi's being offered profit-sharing agreements with Adidas and Apple, and ESPN even says he may get a stake in the club, joining co-owner David Beckham. A fascinating story, Anna, just on the heels of so much kind of sport enthusiasm coming out of the Middle East. I mean, we'll talk about the U.S. story and angle in a moment, but this is coming on the heels of the merger between the Saudi-backed kind of golf tournament with the PGA Tour. This is coming on the back of Cristiano Ronaldo in Riyadh right now, playing for a Saudi team. And of course, last year, the FIFA World Cup held in Qatar. It's fascinating how sports are kind of taking over the Middle East.
Yeah, and the role of these big Middle Eastern players is really interesting, isn't it? Our big take story today actually features the world of global football, of soccer, and talks about the billionaires who are buying up these clubs. And in that, we've seen quite a lot of success from those from the Middle East. So, for example, the Saudis buying a team in the northeast of England with quite a lot of focus news-wise on that. We've seen the Qataris still going after Manchester United, coming hot on the heels of their World Cup success. So, clearly looking to exercise that soft power by both buying clubs and attracting talent to their home teams. I wonder, though, in the Messi situation, you know, you can take the geopolitical view and say, look, he can turn down those Saudi dollars in the way that the PGA Tour can't. Or you can just maybe draw the conclusion that he prefers Miami. He'd just prefer to go and live there. Who knows? Maybe we'll find out one day.
It's a very common move that a lot of people are making, even out of New York, even out of California and Texas as well. I'll also add the fact that there seems to be this kind of influx into bringing a lot of these very popular sports in Europe to the U.S. I want to say Formula One, for example, also trying to make big bets about getting bigger in the state. So to see that extra backing behind David Beckham now as well in terms of Inter Miami, that's enormous for the U.S. soccer market.
Yeah, absolutely. So we'll watch how this plays out for Inter Miami themselves. Yeah, really fascinating to watch the way that the US game is growing, and David Beckham clearly there and trying to drive some of that on the global stage. So fascinating story to continue watching. We were just at the Super Return Conference yesterday with Danny Berger, and we'll be there again in moments. But she was talking just yesterday about private equity interest in the space. Plenty of PE money going into sports of all varieties, we heard in yesterday's conversation. Coming up, we'll talk to Jean Boivin, head of BlackRock Investment Institute. We'll talk about the rising yield environment. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Reality check. Global stocks and bonds digest 2 surprise rate hikes this week, reminding investors that the inflation fight isn't over yet. Wall Street may soon face fresh compliance costs in the U.S. after a reprieve from Europe's tough MiFID II rules expiring next month. And a warning from BlackRock Vice Chairman Philip Hildebrand saying investors must reassess their allocations to China amid rising geopolitical tensions with the United States, as well as a slowing economy. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest around the world, but for some reason, the RBA and the BOC really threw markets for a little bit of a loop here.
Yeah, absolutely, they did. And what was interesting, when you saw the reaction in the Australian bond market, it was actually more to the Bank of Canada than it had been to their own domestic rate hike story. So that gives you some sense of the way that this story of higher yields has sort of gained momentum as we've gone through the week and been reinforced perhaps in investors' minds. This is the Stock 600 right now, down 0.1%, a little bit lackluster. Is that rising yield environment capping our expectations for stocks? Perhaps it is. Certainly capping technology stocks right now. That was the theme on Wall Street yesterday. We saw the Nasdaq down by more than 1.2%. Here in Europe, it's the theme today with technology names under pressure in today's session. The German two-year yield, just like many of the parts of the sovereign debt curve in the Eurozone, we saw yields rising yesterday on the back of those surprise rate hikes. But we kind of digested that, and for the moment, just pulling back a little bit. So we're just down a basis point or so on those yields. Still, after the RBA and the BOC at higher levels and rethinking what we expect in terms of the global rate hiking cycle. Wizz Air, this is an aviation business, as the name nicely suggests, here in, listed in London, based over in Eastern Europe, and we see it is up by 1.7% today after it followed hot on the heels of a host of other aviation names then, Kriti, talking positively about the summer that's still to come. Kriti?
Consumer resilience that is still fueling perhaps those more hawkish bets around the world, and specifically when it translates to the Federal Reserve. I'll get to that in a moment, Anna, but when you're talking about sentiment in terms of today's trade, a lot of that seeping into the U.S. as well. You are seeing futures virtually unchanged right now, 42.74 on those contracts, but a little bit of outperformance in the small caps, and that is a positive sign for the bulls who are saying, look, we're waiting for that breath in the market to show up. Well, you kind of got it. Now the small caps are playing a little bit of catch up to those big, heavier growth names, but again, inflation is the story. Growth is the story, and that's really where those Fed hike bets really matter. The two-year yield at about 4.55 here. Overnight, though, if you look at the swaps market, they are now pricing in a little bit more hawkishness, something that isn't necessarily showing up on the surface of the bond market just yet. Something to keep in mind, especially as we talk about the ripple effects for the greenback. The Bloomberg Dollar Index directionally, at least, following the story of the yield curve, down about 0.2%. What's interesting is the weakness in the greenback not necessarily having a positive effect on the commodity market. NYMEX crude still trading with a 72 handle, Anna, down about 0.4%.
Okay, so those are the markets. Let's get to some analysis. Bridgewater Associates founder Ray Dalio says the US is seeing stubbornly high inflation along with elevated real interest rates. He spoke yesterday at the Bloomberg Invest Conference in New York.
We are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers.
Ray Dalio there. Let's get to Jean Boivin, head of BlackRock Investment Institute. He joins me on set here in London. Jean, very nice to have you with me today. Let me start by asking you about this theme that Ray Dalio is talking about there, about levels of debt coming in particular out of the United States, but elsewhere, of course. I mean, we're seeing plenty of demand for those T-bills this week. Some of those auctions going pretty well. So maybe no lack of demand now, but bigger picture, are you concerned about the potential for a lack of demand as we see governments in Western countries issue so much?
I don't think this is the concern of too much demand is an issue for the near term. I mean, markets are pretty relaxed about the debt picture. You know, this is one of the things that hasn't, the dog that hasn't barked is record level of debt, and yet, you know, investors very happy to get exposed, buy more of these government debts. We've seen yields, you know, falling actually or being flat throughout the year, despite central banks raising rates. So I think this story is one that is on the radar. I think that is something that will be a market driver eventually. But in the near term, I think this is more of a central bank story and how they're going to play.
Right. And thinking of that central bank story, we've had a real reminder this week of even if you get a pause, even if you get a skip, that doesn't mean you're done with hiking. We got that from the RBA and we got that from the Bank of Canada. Does that have read across? Is the market right to build up expectations of Fed rate hikes in the wake of those moves?
Well, from our perspective, the biggest disconnect this year was the fact that the markets were expecting some quick easing cycle to start, rates to be cut by the Fed, despite the fact that, in our view, we haven't made any progress really on inflation. Core inflation over the last 6 months have been basically moving sideways at a level that is not satisfactory, 5% type. So that disconnect has been now, you know, disappearing. We've seen the market in the last few weeks start to move and price out these cuts. I think the Bank of Canada is adding to this, confirming that, you know, this is a world where inflation problem is not being resolved yet. It's going to require at least central banks holding steady and keeping rates at the level that they are right now. So the high conviction is no cuts anytime soon from our side. And the risk is towards a bit more hikes to come. And I think the Bank of Canada, in this context, a bank that was trying to pause, you know, has really positioned for that, and now has kind of been forced to re-engage in hiking, shows that, you know, that I do think there's a read across from that.
Sean, in addition to kind of the changing narrative around these central banks, as you just pointed out, talk to us a little bit about the liquidity picture here. As we see another big jump in issuance, both from sovereigns and corporates, is there a concern about digestibility in this market?
Yeah, I think we are. There is a bigger, you know, dynamic at play in the liquidity banking sector, you know, picture. We have certainly the debt ceiling, you know, being behind us now. We're going to see a lot of issuance coming back to the market. That's going to be happening very quickly, and will, I mean, it will be something to watch. Could create some pressure. I think beyond that, we are seeing, you know, a dynamic over the last year since the Fed has started to raise rates that has been putting pressure on the banking sector. We have seen deposits outflows from the sector, you know, in the tune of 800, 900 billion, close to $1 trillion now. Of deposits outflow from the system. So you put these things together, and I think that's an environment where we are seeing tightening of credit condition, liquidity conditions, and I think that has more to play out, and it could come with some volatility along the way as the market digests, you know, these issuance over the next few weeks.
What about the pressure theme from China specifically? Is the Chinese read-through into some of these Western economies the same as it was, say, 10, 15 years ago? How are you thinking about that side of the world?
No, I think this is very different. So, when you go back over the last 10, 15 years, you were trying to think about China in terms of how much of a cushion you can get from, even if we were going into a tougher spot in DM economies, how much of a support cushion you could get from China. I think this is a very different story now. First of all, I mean, the growth dividend from China on the international market, I think, is lower than it used to be, given the geopolitics that is happening, the rewiring of globalization that we're going through. That's certainly one thing. And then also, I think the domestic resilience of the Chinese growth is more at risk now. We used to say the farther away you're from China, the more bearish you are. I think this environment has been flipped. That has been flipped a little bit. I was in Asia last 2 weeks, and it's a bit the opposite. I think the closer you are to China, the more you feel some concern. And the Chinese consumer is clearly showing lack of animal spirit at this juncture. So these are the big questions. So I think it's very different, and less support from the global economy from China, I guess, in this tougher environment is for us the bottom line.
Some really interesting perspective then on China following your visit. Jean, let me ask you about AI and your expectations. I mean, there's a lot of either hype or excitement, depending on how you see it, and a lot of that increasingly built into stock markets. Do you see this as a technology that could be deflationary? I talked to one guest who came in from Federated Hermes, who was making that point, saying that this could be something that reduces the way that the tight labour market and high wage or rising wage story is filtering through into inflation. We might have to wait some time, but is that where we're heading?
So I would start by saying that I think this market environment is one where this is less about the macro environment and are we going to see a recovery, recession over the next few quarters. I think it's more about mega forces. AI is one of them. I think we're thinking of the climate transition as being another one. Geopolitics, globalization, reward. These are all big forces at play. I think they all have implications for inflation. So, I mean, the globalization reward that we think is inflationary. We're going to see higher cost of production globally. Demographic is, at this juncture for us, inflationary. We're seeing a lot of tightness in the labor market because of demographics. AI is a third force. Eventually, I think you can tell the story where we're going to get productivity gain. We're going to be able to produce more efficiently. That could be reducing costs and be lowering inflation. But before I get convinced on that, it's going to take some time. And I think this is a story for like maybe then 5 to 10 years down the road, as opposed to the inflation problem we're facing now.
I'll ask you that again then in 5 or 10 years, Jean. Thank you very much. Thanks for coming in, Jean Boivin of BlackRock Investment Institute. We thank Jean for joining us today. Coming up, we will be back to the Super Return Conference, our live interview from that conference in Berlin with Joe Taylor, CEO of Ontario Teachers Pension Plan. Danny Berger will be back with that shortly. Plus, we'll have more from the Bloomberg Invest Conference in New York throughout the day, including Kriti's panel with executives at Nuveen, Blackstone and Lazard on managing pressure with alternative perspectives. This is Bloomberg.
I'm honestly most looking forward to my relationships with the founders. I'm really fascinated to hear their backstory. I'm a storyteller. I'm so excited just to have the opportunity to help them win.
That was Kim Kardashian presenting her debut private equity fund to a sea of curious investors in Berlin at the Super Return Conference yesterday. Bloomberg's Danny Berger is at the conference and joins us now with CEO of Ontario Teachers Pension Plan, Joe Taylor. Danny, take it away.
Kriti, that's right. I am here with Joe. Let me tell you, he's just as popular at this conference as Kim Kardashian is. Crowds around him, too. Maybe less security guards, though, Joe. It's so good to see you. Thank you so much for joining. Look, we've talked about this a lot, just Ontario Teachers being a different beast. I mean, you're so large, you invest in many different things. You're like a hedge fund. So let's talk about the private equity portion of that. This year and beyond, have you rethought its place in your portfolio?
Well, we're very thoughtful about private equity because it's a large part of our portfolio. It's about 60 billion of almost 250 billion of assets at the end of last year, which was our last published numbers. I think the issue for us in private equity is, rather than looking at some of the challenges, try and see where we can provide good solutions. So we're talking to private equity firms about helping them with their liquidity. So that's either investing in their funds as an LP or actually trying to help them to sell companies to a responsible owner where we can take it on either with their continued involvement or on our own to the next level as a longer-term provider of funding.
And on the investment side, what type of fund right now do you see that's returning alpha? Who's doing a good job in a difficult environment of still delivering returns?
Well, I think a lot of private equity firms need to ask themselves, why are they distinctive? It's the same we ask ourselves, what sort of brings out the best in Ontario teachers within, say, the pension fund community. We would probably say that for us is our agility, as you alluded to a minute ago. So if I go back to your question on private equity firms, I think what we're looking for is somebody who has a distinctive investment style, has good returns in terms of proven track record. But I think what the community can really think about is how well do you partner with people? So if you can actually have a trusting working relationship with partners, I think that broadens your opportunity set. And for us, it's all about trust. Yeah. If we can work with people where we think we've got a good dialogue, and we can work together to actually find a better way for the businesses we're both invested in, that's a great result.
Now, I know we're here in Berlin, far away from Canada, but Canada has had an interesting week on a macro scale. Bank of Canada, surprise hike yesterday. When it comes to inflation and a peak, a pause, an extended pause in interest rates globally, have we been a little bit too sanguine on the end of rate hikes, the peak of inflation?
Well, we've said for a little bit we didn't think that the rate hikes were over. So we weren't hugely surprised by the Bank of Canada's 25 basis point lift this week. I think it's quite likely to occur again in the US. We're very much in the mode of inflation's going to be stubborn and around for longer. Interest rates, therefore, need to also be high for longer to try and correct some of that. So what we're trying to do with all of that is say, where are the opportunities? Where are the businesses where they have something of a tailwind rather than facing headwinds at the moment because of those two activities, higher interest rates, higher levels of inflation.
Are you worried about a recession?
I think we're anticipating there will be recession. Are we worried about it? Well, it will have an impact on some of our companies. We need to help them through that. The beauty about being a long-term patient provider of capital is we can work our way through it.
But of course, it's not just private equity. As I mentioned, you're in so many different asset classes. So how do you protect yourself if there is a recession, if there is a worse downturn?
Well, the beauty about being in lots of different asset classes is where some are struggling, others will benefit. So if you look at our approach, we've been relatively creative investing in commodities, investing in alternatives to fixed income, particularly things like infrastructure investing. And our big issue, if we look to our own issues, are, inflation is a challenge for a defined benefit pension plan of our scale. So whatever we can do to mitigate the impact of inflation, we'll be pretty actively looking at that.
You haven't mentioned public equities. How do you feel about them? How has your exposure to them changed this year?
So about 25% of our portfolio is in equities. The lion's share is in private equity, about 70% of that number. So our allocation to public equities is already quite light. I think we've seen more recently, in terms of the rally in public equities, it's been very concentrated in, again, a few mainly technology stocks. The rest of the market is, I think, not really progressing as strongly as people imagine.
Are those the mega cap tech plays? Okay.
Yeah. So the FANG stocks, essentially. And I think for us, what would we say? I think we would say that there's probably more risk on the downside than there is opportunity on the upside at the moment.
Are we talking like a correction, a further bear market?
Well, we've been speculating whether there would be a correction really since the fall of last year. So for us, it's a little bit overdue. So why would we think that? We would see risk in the Ukraine, which is still a situation in Europe that's not been resolved. And there are other issues on the horizon. I think food's an interesting one, which could actually be another catalyst for some economic correction. But I think overall, interest rates is probably what's going to drive down spending from consumers.
Right. And Joe, you've of course invested through a few cycles yourself. How do you feel about this new generation, which has had to deal with work from home, has had a lot of disruptions? the folks at Ontario Teachers. How do you think about the new generation's ability to deal with this downturn we're in right now?
Well, I'm learning, I think is the honest answer. I have to sort of reorientate to try and understand what Generation Z and beyond, going backwards, are looking for in life. I think they have more flexibility. I think they have more views of what they're looking for in an employer. So we try to portray very much our purpose orientation as an important way of attracting and retaining those people.
Are you hiring from banks, speaking of which? You've been letting folks go.
I think we're hiring from everywhere. You know, for us, what we want are both people who are financially literate, but also people who can innovate. And I'd say, in terms of your question, to me, the really interesting thing is what younger people want to buy and invest in these days is a little bit different. So you've seen a really big change in, say, travel as a driver of value. So, you know, we own 5 airports, and actually it's really been the leisure travel that's driven the recovery more than business travel.
Okay. Joe, I'm afraid we're out of time. Really great to catch up with you. I know you're sick of me. We've done a panel, we've done this interview, so I'll let you go. Anna, that is Joe Taylor, CEO of Ontario Teachers Pension Plan.
Danny, thanks very much. Danny Berger joining us there from Super Return over there in Berlin. Now, coming up on the programme, can Uber go all electric? We'll bring you our interview with the CEO, Dara Khosrowshahi. That's coming up next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Uber wants to cut emissions to zero by converting its entire fleet of cars to electric by 2040. But to do so, the ride-hailing giant will need support from both drivers and riders. The CEO, Dara Khosrowshahi, explains the company's new sustainability features to Bloomberg's Emily Chang.
It's pretty significant. Generally, the footprint is based on essentially all the miles driven. We completed 2 billion trips this last quarter, and we've got to do everything that we can in order to reduce that footprint, and we've committed that by 2030 in the US and Europe and Canada, we're going to be all electric, and by 2040, we're going to be electric all over the world.
That's an ambitious target. Uber wants to cut emissions entirely. So for this ride-hailing giant, that means getting to total electrification, which would be nothing short of a green miracle. It's all part of the company's sustainability agenda, called Go Get Zero. So let's paint the whole picture for me. This whole Go Get Zero push. What's the goal, and how will you get there?
The goal is to go electric and create the incentives for drivers to go electric as quickly as possible and riders to pick electric as well. So the smart charging technology is allowing drivers to know when and where to charge, to feel safe to get routes that are efficient. Yeah. Then on the rider side, one new feature that we're introducing is actually a feature for you to see how much you're saving in terms of emissions. So when you get that green car or when you get that Comfort Electric, we'll show you how much you're helping out the environment, how many emissions you're saving. We have to get that flywheel together. We need drivers to choose electric, and then we're going to put more and more electric options in front of consumers as well.
How much more does it cost to ride electric?
If you're taking green, actually it's the same exact price as an UberX.
So are you taking the hit on that, or does the driver take the hit on that? Where does that cost?
We take the hit. So we've said that we are investing $800 million in the transition to electric, and we've got to make it economically sensible for drivers. So for example, our take rate on electric rides is lower because right now, generally EVs cost more than combustion engines.
Right. Emily Chang there speaking with Uber CEO about the company's electric future. And we should note, tonight is the premiere of The Circuit with Emily Chang. You can catch that new show every Thursday at 10 p.m. Eastern Time on Bloomberg Television. A quick check on these markets here. We are seeing futures virtually unchanged when we look at S&P and the NASDAQ. But the Russell 2000, those futures outperformed by 0.2%, 10-year yield 379. That's it for early edition. Surveillance is ahead. This is Bloomberg.